President Trump says Fed Chair Jerome Powell is costing our country hundreds of billions of dollars. He's truly one of the dumbest and most destructive people in government, and the Fed board is complicit. Well, he definitely has one thing right about that. I'm an independent, no political affiliation, whether it be Democratic or or Republican. But one thing that Trump is absolutely correct about is the fact that the Federal Reserve, namely the Federal Reserve Chairman Jerome Powell, is being an absolute is literally being an absolute destructive force to the United States economy. So much to the point that if something isn't done soon, then we are going to be experiencing a recession like we have never seen ever in our lifetimes. All right, what's going on, everybody? This is the Investor, and welcome back to the Investors News Hub on our YouTube channel. Okay, definitely feel free to check out all of the stuff that we have. Again, this is something fresh, this is something brand new, and we're definitely super excited about it. But this is the central area where we talk all things stocks, macroeconomics, and more importantly, how you can make better investment decisions for yourself. Okay. Today, we are going to be talking about how detrimental the Fed is actually putting the United States right now and this is particularly worse than the dot-com bubble of 2000s, the market crash of 08, and even COVID-19. The way that this is actually looking, the Federal Reserve is going to put us long-term in a very, very deep recession that most people are not quite prepared for. We're going to actually be taking some time to break this down real quick. Okay. So first and foremost, I think it's super important to first start off with, and if you guys haven't seen our last video of our target immediately going to 5,800, then definitely feel free to check that out before listening to the entirety of this. Okay. As it currently stands right now, the Federal Reserve has continually been late in majority of financial situations. Why? Because they're always looking at empirical data that is delayed probably about a month and some change. That is being released out a month prior. Okay, and so the issue that we have currently at hand right now is the fact that the United States is in a very, very crucial area where it's doing a lot of restructuring in terms of its monetary policy, but ultimately its monetary structure according to the country. Why? Because the Federal Reserve has printed so much that beyond this point, and not only has the Federal Reserve printed so much, but rates are extremely high to the point that we are closer to a 1929's version of a recession or even a Great Depression rather than anything else. And it's not only because of the Federal Reserve, but it's because of the financial system that has been holding up the markets for over 100 years now. Okay. Now, the very first place that we're going to take some time to really break down is that how we're sitting at 6,300 right now, and our target, as you can see, is 1,500 between 2026 and probably 2028. Okay. Let me see if we can get this corrected real quick. Is that the answer? No, it is not. We will figure that and fix that later. I don't think we need this right now at the time being, though. Okay, but as you can see, this target that we have here is 1,500 max for the S&P 500. Why is the Federal Reserve something to be worried about right now? Why? Because it's the heart of the financial markets when it comes to the United States economically. Okay. And the thing that you got to take some time to understand, though, right, is that the Federal Reserve right now is probably one of the issues that we have. The biggest one that we currently have at the current time and moment is actually the Japanese yen carry trade. Okay. as you can see, and we're going to take some time to break this down even further. But if we actually go to the S&P 500 right now, and you can see where we actually have our targets set up from last week and given to our community, what it is that we're actually going to take some time to do, we're actually going to go to July of last year to see what happened to the markets. Yeah, July, end of the month last year, in relation to the Japanese yen carry trade. So once again, if you're unaware about what the Japanese yen carry trade is, it is a trade strategy where you have the Japanese yen at lower rates, and so when you have the exchange between dollars to yen, you're able to capitalize off of the difference in terms of the exchange rate. This is something that many bank entities and individuals utilize in order to profit off of the currency difference. And the con when it comes to it is that the smallest reduction or change in rates, and whether it be the United States, whether it be the rates put onto the United States in the dollar, or the amount of rates that are put on the Japanese yen, the smallest increment of an adjustment can otherwise unwind this entire thing here. And as you can see, we have our vertical line sitting here at July 31st. And the reason why is because, as you can see, if we go back around the time of July 31st, right, you have the value of the Japanese yen sitting around 160 in relation to the Japanese in relation to the US dollar. Now, as you can see, Japan is typically a bit early, but as you can see, the moment that this starts cratering and we get closer into the end of the month, the United States and the stock market eventually feel the burn of it the start of August, where we see, and we can just switch to candlesticks real quick, we can vividly see the breakdown immensely going from 555 all the way down to 540 in one day, and then hitting down to 510 in less than 2 days. Okay, so with that, 2 trading days, so you have August 1st, you have August 2nd, and then it bottoming out August 5th, that Monday. Okay, that is just a snippet and an inkling of what had happened in regards to the yen carry trade that happened last year. And now we're sitting here, and this is what's very particular, right? Because as the Japanese yen continues to diminish, and now we have tariffs running into the equation, the Japanese yen has been slowly diminishing once again, and there hasn't really been too much of a brunt in regards to it. But as you can see, we have a line called LIS. This is what I like to call a line in the sand. Why? Because as you can see, unless the Japanese yen gets above this and maintains its support, if we actually take some time to zoom out, the Japanese yen's target next up after that is another massive leg down, just like we had similarly back in July of last year. And the only difference is, now that we are sitting at all-time highs when it comes to the markets, this could potentially be the thing that craters us not only down to 580s or 5800 on the lit exchange market when it comes to SPX or the actual S&P 500, but more importantly, it could spell quite a bit of what I would probably call a death spiral, because of the fact that you have a multitude of macroeconomic factors that are playing into this now, right? Now, just to put this into perspective real quick, we're going to switch over back to Twitter just to show a comparison of what the overall markets particularly look like right now as it pertains to where we're at. There are a number of people that are saying that the markets are going to continue to the markets are going to continue to go up, where we're going to hit new all-time highs, and there might definitely be some much needed stretch going on. But I think that this chart by this individual is super important. The reason why is because you can see there is a spitting image. It's literally a spitting image of the stock market back in 2008. And the thing is, you have a lot of similarities coming to it. Of course, there are going to be a number of people that are saying, the times have changed. You have AI that is going to be supplying it. You have, cryptocurrency that's going to be supplying it. You also even have, with the enactment of the Genius Act, which is, essentially laying down the regulatory framework for cryptocurrency and stablecoins, that this is going to be any much different. But I'm here to let you know, if we're talking about the current existing financial structure, the current existing structure of the financial integrity of our country right now, then those things do not play much of a factor into what has already transpired, but rather more than what can possibly be transpiring in the future. Okay, so that can be something that is going to be beneficial, but the very same things that have been playing out are going to continue to be the very same things. Now, the reason why I say this is because, as you can see, if we take a look at the 2025 line versus what it is that we have in 2008, this is following even post tariffs. Again, there might have been a different reason and a different purpose back in 2008, because I don't believe that there were tariffs issued in 2008. Okay, but as you can see, we have similar price action happening where the United States Federal Reserve begins to start cutting rates around the time of September. Once again, we have a surplus for the first time in many years going on when it comes to how much money that the United States is bringing in. And this is because this is due to tariffs. This is also due to a multitude of cutting back in terms of federal spending. And so due to the federal spending, we have and due to more revenue being brought in because of the tariffs, we have a surplus being brought in for the first time in many years. But as you can see, as a result of it, federal Fed rates are still high, even though we're bringing in more money than what we were when rates essentially started to rise. So you start to see why, right? We have the headline where we're saying, I don't even know if I still have it up here. We can go back to it, but we have the Federal Reserve remaining complicit when it comes to cutting Fed rates, right? We can see this firsthand right now to show you how bad that this has actually gotten, right? And we're just looking for the we're just looking for the yeah, that's good enough, right? We can start to see the federal, and start to see and understand why the Federal Reserve is starting to is like, people are saying that the Federal Reserve is complacent, is because they're doing an exact spitting replica of what happened in 2008, where you cut entirely too late because you're paying attention to the wrong information, the wrong data when it comes to the markets, right? Now, what is this essentially? What other things can we actually take some time to take a look at outside of news headlines, the Japanese yen carry trade? Well, we can take some time to look at the bond market, but I think what's more important is actually taking a look at the effective federal funds rate. Why is this super important? Because this can actually allow you to understand, right, what is essentially going on when it comes to the overall markets and what essentially happens, right? Now, for people who are unaware, right, what are the effective federal funds rate? The effective federal funds rate is essentially the rate by which the Federal Reserve is able to issue out, is when, say for instance, the Federal Reserve were to issue out money in some case, way, shape, or form, right? How much at the funded rate are you able to do that? Okay. And I think the best and better way to really explain this is just to simply type it out on Grok, right? So if you don't want to take my word for it, well, we're going to take some time to use Grok. What is the effective federal Fed fund rate? The effective federal funds rate is currently 4.43, with no change noted in its most recent data. The effective federal funds rate is the interest rate at which depository institutions lend reserve balances to each other overnight to meet reserve requirements set by the Federal Reserve. Its importance lies in several key areas. It's a monetary policy tool. The EFFR is a primary tool used by the Federal Reserve to influence economic activity. By adjusting the target range for the federal funds rate, the Fed can control borrowing costs, affecting inflation, employment, and economic growth. You can already understand why right now Trump is trying to get the Federal Reserve to cut down and slash rates. Now, of course, he's been saying we need to slash by 2 points, 3 points. It's not that simple. But again, the main thing to focus on, and the reason why we're talking about this, is because the Federal Reserve continues to be late on the most important economic topics in the most economic times, and the cost of it is the fact that it is hindering, or rather, it is costing higher borrowing costs. It's affecting inflation itself, employment, and overall economic growth. So as the higher inflation, the higher the Fed funds rate is, that is a very key factor in why inflation and spending money is so high. Okay, the benchmark for borrowing costs. Okay, so whenever it is that you go, and this, you can see this prevalently when it comes to mortgage rates, right? Whether it be rates on loans, cars, credit cards, savings accounts, it is extremely hard for the average American citizen to borrow, simply because of the fact that the effective federal funds rate is significantly high, and the Federal Reserve is not paying attention to the right information in order to cut. So if you're ever trying to figure out why it's still hard, it's still increasingly difficult for you to borrow money, whether it be to get a car, you have these high mortgage payments, you have these high car loans. It's because of the fact that the effective federal funds rate remains to be at the high at the rate that it is. Economic indicator, the EFFR, reflects the Fed's stance on the monetary policy. A higher rate signals tighter policy to curb inflation, while a lower rate indicates stimulus to encourage borrowing and economic growth. Now, this is where it gets very, very tricky. Why? Because of the fact that if we actually head back over and actually look at the effective federal funds rate, we can start to see in numerous occasions that the Federal Reserve continues once again to be late in not only our present day, but also many other situations. The first one being the dot-com bubble. Okay. So again, we have rates rising extremely high, and then at some point when we get that cool down, the Federal Reserve is essentially too late on cutting, and then it starts to break the economy down because there's not enough money coming in, which now results towards a deflationary phase. We also have a repeat of this where now the effective federal funds rate starts going down after a while and flattens in 2004, and then kicks and ramps right back up to combat the dot-com bubble. And then this brings us to 2008, where now once again we have the Bearsteins, we have the Lehman Brothers. You have all of these loans being loaned out by the banks. at such a high interest rate. People are not paying the interest rate. There's no stimulus coming in. There's no growth coming into the country. And then now when you have a moment and opportunity for you to lower Fed funds so that way it can be a lot more ease onto the American people, once again, you're too late. And then that results into the financial market crash of 2008. Once again, we're at COVID. You would think that the Federal Reserve would have learned its lesson 2 or 3 times around. No, yes, 100% did we have the COVID-19 crash, but essentially what ended up happening was the markets were bound to crash anyways, regardless if COVID-19 happened or not. Why? Because once again, the federal funds rate in relation to the economy didn't match up. And so once again, the Federal Reserve continues to be late. And then this time, the difference is now we have such a growth spurt, or because of the amount of stimulus being injected, the amount of printing into the economy, to the point that now we are right back at the levels of the federal funds rate as it was back in 2008. So for all the individuals saying that we're going to see newer highs, is there a possibility for this to go for this to go higher? Yes, but at this point we're reaching a churn at this point, right? And again, what's even worse beyond this is, like I said, when you take this as well as the yen carry trade into effect, we saw how it affected and shook the markets last year, July. But what we have not seen since 2020 is how in the world is the economy going to be affected by the Federal Reserve being late once again on adjusting and lowering interest rates. Okay. What's even more important in this is that you can actually see, and this is the reason why we have the banking sector pulled up, right? But you can actually see that because once again the effective federal funds rate is so high, or interest rates, it's become increasingly hard for people to borrow money but pay it back in the process of it. Okay, so once again, these are the exact ingredients that created the financial crash of 2008. And as you can see, whether it be regional banks or even your higher end banks, we are reaching a plateau currently right now, where once again, if we go back to the initial picture that we're looking at, we are simply going down the list as to what is going to create this. So for everybody thinking that this is going to go significantly higher, I want you to know and understand that that may not be the case. Okay, that may certainly not be the case in any way, shape, fashion, or form. Because as it currently stands, if we actually take some time to look at the charts now, we can actually take some time to understand that the banking sector is in major jeopardy. Okay, we can go, and these are just for smaller regional banks. The JP Morgan, and this is just a very helpful tool. As you can see, we thought already that this was well overdue for a drop, and we didn't get that correct. But as you can see, we are coming up at a very large plateau when it comes to the banking sector as it currently stands, right? And with no pause, no support in mind, if something is not done very, very quickly, then JP Morgan can be headed back all the way down to 256 with a minimum target of really 260. Okay. Same thing when it comes to Goldman Sachs. We're heading at a large plateau here, okay? With no supports, nothing dropping down below. I do believe Wells Fargo at the current moment, you can see it more prevalent in Wells Fargo because of the fact that they did good on their earnings. However, it dropped regardless of it. Okay. So there are a number of things that are happening in real time, and though yes, we can take a look briefly at our at our stable coins like your XRPs, okay, and your Ethereums and many others, and they've been getting quite a bit of a jump due to the passing of the Genius Act. We've actually been invested into XRP since one. I believe our average is actually 39 cents, which is great. No, I actually think it's 51. I gotta look. I don't think it's that high because we bought more previously, right? But as you can see, there's going to be quite a bit of opportunity in terms of the crypto industry and stable coins for years to come. But that first has to, in order for that to be of the future, guess what? There has to be a dismantling of what is currently existing at the current moment. Okay. And I think what's even beyond this, and we just have a little quick overlay. You can see that the United States dollar is heavily pegged to the Japanese yen. Okay. So what be crypto, be Bitcoin, it does not matter in our personal opinion. If something is not done in terms of these factors, in terms of interest rates, in terms of the Japanese yen carry trade, and interest rates in general, because they're all tied to one another, we are going to be experiencing something very, very ominous ending out the month of July and probably opening up the month of August. Okay. As you can see, we still, though, and we made an Instagram reel on this, and it's been quite popular with people saying like, oh look, he just drew a line and that's it, right? Well, I want you to know and understand that as it currently stands right now, unless this line gets probably above 640 or so, this is still intact. This is very well still intact. Okay. So what Trump is essentially saying, you don't, this is what it is that I always like to say, you don't gotta like the guy, you don't gotta be supportive of him, but I will say that he's the one person that probably understands business more than anything based off of the progression of his presidency in his second term. The Federal Reserve remains complicit. He's trying to get things done. There have been numerous blocks to it, and I think that in and of itself is another rabbit hole. But what you see in real time happening is the restructuring of the United States and the monetary policy and structure that has been holding it up for the past 100 years or so. We can see that the current entity that we have with the Federal Reserve is not the most effective, and it hasn't been the most effective since it's actually been created in 1913. Okay, the Federal Reserve is the reason why we had the Great Depression of 1929. The Federal Reserve is the reason why we had the dot-com bubble. Right, there's it seems to be just the same reason, but different entity. I mean, different repackaging or reframing of the initial narrative every time, whether it be the dot-com bubble, the housing market bubble, COVID-19, and even this time when it comes to AI. Okay, so when it comes to all this, right? If the Federal Reserve does not do something quick, we are in for something very opportune but very monstrous at the same time. Okay, so if you guys like this continuation, definitely feel free to follow us for more of these videos where we take some time to dissect stocks, whether it be crypto, whether it be dividends, whether it be talking about macroeconomic information. Our goal is to provide you with the most information for you to make better investment decisions. Okay, so hope this video helps you guys. Definitely feel free to like, comment, subscribe if you found this helpful, and I will catch you guys in the next one. Take care.